Welcome back to Primary Source China Investment. After a week of hiatus and a little bit of stomach virus, we're back with show J3. And this week, we wanted to talk a little bit about how some foreign companies have executed their business plans in China and what's the best way to capitalize on that investment. And sometimes, running your own business sounds like the best idea, but may not always work. So we have three examples today. We're going to be talking about Uber, Walmart, and JPMorgan. These are three companies in three different industries. So before we kick it off, I wanted to throw it to you, peng.guo, and just get your thoughts on, how we frame this in terms of foreigners competing on the mainland.
I think a mainland market, probably like the Beijing real estate market. So it's like an international market. So all the companies globally, they come to this market. It's very competitive. They just use whatever advantages they have, just do business in here. In the financial area, we know this is a highly regulated area. We know this is very important to get the license. So even after you get the basic couple of things, you have no difference. Like other domestic companies still face how to run business in China. In my understanding, most of the U.S. company or other foreign company, they have a lot of great experience. They have the mature system. They just try to leverage those kind of things in China, but and especially for like the some of like the management or customer service philosophy, the high level that would be good, but in the detail, in the execution level, that's a huge difference.
Since you mentioned financial services, maybe we'll start with the JPMorgan example. So JPMorgan on the investment management side, so the asset management business, first came to China in 2004 through a joint venture with Shanghai Trust. So they got their first license in 2004. And I want to contrast that with China Merchants Bank, because China Merchants Bank also entered the asset management business around the same time, about 15 months early. Viewers have to remember that the asset management business in China was only started in 1998. And my old firm, Guotai, was the first company to get an asset management business. This is only 1998. So China Merchants Bank and JPMorgan got their licenses within 15 months of each other. At that time, and to this day, China Merchants Bank maintains a close relationship with Shenzhen government, but also enjoys massive brand recognition throughout China. Right now, China Merchants Bank manages $150 billion equivalent. JPMorgan manages about $20 billion equivalent, about as much as their US large cap equity mutual fund. So they started around the same time. China Merchants Bank has 150 billion, JPMorgan has 20 billion.
That's definitely a great question. So it's I think firstly, from the management, the top level management perspective, they get a huge difference. So China Merchant Bank came from the Shenzhen. Shenzhen is whatever market driven. So that's whatever suited to the market. They just do it. And the Shenzhen government encourage the startup, or even like the merchant bank. This is not like a startup, but it's a new business like a startup. So anything new and good have a bright future and easily to get the Shenzhen government support. Mm-hmm. And the Shanghai is definitely different from. So in Shanghai, most of you can heard the people looking for job, not starting their own company. So they're pretty much compared to Shenzhen, the lack of the startup environment. So JPMorgan select Shanghai as the city to resident there. That's no problem because Shanghai used to be like the bigger financial center to doing that. That's a tradition. So that really means JPMorgan doesn't do deep fundamental research for the asset management this business. So this asset management business, so they should like the stock investor to deep understand where the asset management came from and the driven came from. And secondly, I think probably from the distribution channel. Because in China, the bank is a major distribution channel.
Absolutely.
If you rely on that, you can easily expand your client. But this JPMorgan, if they choose the Shanghai Trust, they, as JPMorgan level, they should align with like the construction bank or
no, they
merchant
also
bank, something
no,
some level.
Their other partner was Pudong Development Bank. So it's
that's
not, they did have a bank as a part. I mean, it's not China Merchants Bank, but they did have a bank as a partner as well.
Yeah, that really means the difference between the PUFA's bank and the China Merchant Bank.
Okay, so part of it is distribution. There's no doubt about that. But I mean, we're talking 20 years, peng.guo. So in 20 years, JPMorgan should be able to catch up. And my point here is it's very difficult to catch up. And remember, I'm not even talking about China Merchants Bank asset management arm from the bank, because China Merchants Bank also has a bank fund management company, and they manage even more than their asset management company from the wealth management. So they manage $320 billion outside of the first $150 billion I talked about. So in other words, China Merchants Bank and JPMorgan are not competing in the same league on the mainland. And finally, since 2004, we're going to put up a stock chart. China Merchants stock is up 825%, and JPMorgan's is up 240%. And the final point here is, if you can't beat them, join them. And this is going to be a trend in the three examples. In March of 2021, JPMorgan bought 10% of China Merchants Bank for $410 million.
Yeah, that sounds a good deal.
But what I'm saying is maybe 20 years ago they should have done that and just said, you know what, just let China Merchants Bank do that. So the second example I want to bring up is Walmart. So Walmart entered China with plenty of optimism and a massive market in Shenzhen in 1996. Its primary business has been limping around the mainland ever since. So where did Walmart find success? It actually found success through investing and partnering with its competitors. As far back as 2006, Walmart purchased 35% of a Taiwan company that was doing business on the ground called Trustmart. At the time, they operated about 100 stores. And then it made perhaps its most profitable deal. They invested and then bought outright Yihaodian, which was an online platform, and then partnered and invested with Jingdong, JD. So that's a popular name people know. That was in 2016. That initial investment and a follow-on of 1.5 billion in 2017 is now worth 10 billion. That's even after a 25% decline this year in JD. All while their core business of opening up stores has declined. So from their peak stores in 2017, they're down 15% in peak stores. So what is this mash of information telling us? This mash of information is telling us it's hard to compete, particularly in fast retail on the mainland in China. There are so many competitors.
That's true. This business always have a competition. They always have a cooperation. So it's especially in China, just both exist. So no matter like the internal of the company or outside with other bigger competitors, it really depends on how you streamline the entire chain and how to provide the value to the customer. But generally speaking, Walmart is like the popular store in Shenzhen. And I like the Walmart store.
Yeah, of course. People do like the Walmart store, but are they really, preferring it over other brands? There's so much other competition. Partnering with some local brands has been the better move for Walmart than trying to compete outright.
Yeah, I think Walmart is also, if aligned with the Jingdong, that's also capture the e-commerce expansion. So that is the China new economy. So always take the biggest cake. So that is the biggest part in the past 20 years.
Yeah, and then the third example we're going to touch on is DD. and Uber. So a year after Didi launched, Uber came to China. And at the time, they had a lot of money and they were using it very aggressively. The problem was Uber was only using a foreign credit card payment system, and they were opening themselves up to some type of fraud and other regulatory risks. At the time, Uber China was losing $100 million a month. There's even a Harvard business case you can look up. Eventually, Uber management capitulated and sold to Didi in 2016, getting a 19% stake. The equity value in Didi at the time of the transaction, the private market was worth about $1 billion. When Didi went public, that stake was worth $8 billion. 12 months later, we see what happened with Didi stock, and that's probably only worth $1.3 billion. But the point here is Uber stopped losing money and turned that investment into a real equity investment. And they were getting killed by Didi because Didi was adapting locally. And Uber was using the wrong type of maps. They were using the wrong type of payment system. They were incentivizing drivers in the wrong way, so people were scalping them. So there was a lot of problems that Uber could have figured out, but they just went in blindly.
Yeah, that's actually because of Uber and the Didi, they impact everybody's daily life. So you can feel their service. You can feel what's the value. Talk to the driver and your personal. I personally have experience how they handle how do they take the Uber and the Didi car. So that's quite sensitive to everybody. It's still entire operation. I think is difficult. It's not easy, especially in the high competitive market. Because they face other competitors and also have a local one.
Yeah, I don't know if it was a management team or an access issue, because I was an early adopter of Didi. And at the time, Didi was partnering with Dazhong, the big taxi company in Shanghai. So they were partnering with the taxi companies. Uber was partnering with the sort of black car service, the private car service. And that was dead on arrival, because obviously in a place like Shanghai, there's so many more public taxis than there are black cars. So that was a failed business model from the jump. But I'm not sure if it was an access issue. In other words, only Didi would be able to partner with Dazhong, the big taxi company. So
that really means that most business could lead to failed, and only a few ways could be successful.
Yeah,
you have to figure out what's the right way to go.
Yeah, sometimes, and we talk about that a lot on this show. We talk a lot about follow the policy, and you're gonna find success. So with that, we're gonna leave it with show J3. Thanks for tuning in. Appreciate your patience getting this show out. We'll see you next week.
Thank you.